There's a financial system operating right now, at this very moment, that's larger than the economy of the United States. It holds somewhere between $60 and $200 trillion in assets. It facilitates trillions in transactions every year. And here's the remarkable part: nobody can fully audit it. Not the IRS, not the FBI, not the Financial Stability Board, not any government agency anywhere in the world. This isn't a conspiracy theory, this is shadow banking. And the offshore trust industry that powers much of it has become so complex, so layered, so deliberately opaque that even when regulators get glimpses inside through massive data leaks like the Panama Papers or the Pandora Papers, they're only seeing fragments of a much larger machine. In 2016, 11.5 million documents leaked from a single Panamanian law firm called Mossack Fonseca. The data dump was massive, 2.6 terabytes. It revealed over 214,000 offshore entities connected to world leaders, billionaires, criminals, and tax evaders across more than 200 countries. And that was just one firm. One relatively mid-sized operation in the offshore world. 5 years later, the Pandora Papers dwarfed it. Nearly 12 million documents from 14 different offshore service providers. This time, 2.94 terabytes of data exposing 336 politicians and public officials, 35 current and former world leaders, hidden behind 956 companies in offshore havens. And still, investigators openly admitted they were only scratching the surface. Because here's what those leaks revealed. They didn't expose some shadowy underworld operating in the margins. They exposed the fact that there's an entire parallel financial system, a shadow banking empire that operates with its own rules, its own infrastructure, its own ecosystem of lawyers and trustees and financial advisors, all working to keep wealth invisible. And the scale is staggering. According to the Financial Stability Board, shadow banking held about $63 trillion in financial assets across major global jurisdictions at the end of 2022. That represents 78% of global GDP. Other estimates push the number even higher. Some research suggests that when you account for all non-bank financial intermediaries, the figure could reach $148 trillion by 2032. And when you factor in the full scope of offshore wealth, hidden real estate, art, yachts, trusts, layered within trusts, the estimates balloon to $200 trillion or more. To put that in perspective, the entire United States economy, the largest in the world, is about $27 trillion. We're talking about a shadow financial system that could be 7 times larger than the American economy. And it exists in jurisdictions most people couldn't find on a map. The Cook Islands. That's an almost impossible burden. Which is exactly the point. Nevis, a tiny Caribbean island with a population of 11,000, offers similar protections. Want to sue someone who's hidden assets in a Nevis trust? First, you'll need to post a $100,000 bond just to bring the case. Then you'll need to hire local attorneys, navigate local courts, and again, prove your case beyond a reasonable doubt. The entire legal framework is designed to be a fortress. And it works. There are essentially no recorded cases of creditors successfully piercing a properly structured Cook Islands or Nevis trust. 0. The jurisdictions have built their entire economies around being impenetrable fortresses for wealth. But it's not just the islands. The British Virgin Islands, the Cayman Islands, Belize, Bermuda, Panama, Switzerland, Singapore, even U.S. states like Delaware, Nevada, and South Dakota have all become key nodes in this network. Each offers some combination of secrecy, favorable laws, and non-recognition of foreign judgments. Now here's where it gets complicated. And this is why auditing this system is functionally impossible. Because the real power of the offshore world isn't any single jurisdiction. It's the way these jurisdictions work together in layered structures that create nearly perfect opacity. Let me walk you through how this actually works. Say you're a high net worth individual, someone with $50 million you want to protect. You don't just open a bank account in the Cayman Islands and call it a day. That's amateur hour. Instead, you hire a specialized law firm. They set up a Cook Islands trust. The trust owns a Nevis Limited Liability Company. A Nevis LLC owns a British Virgin Islands Corporation. The BVI Corporation holds a Swiss bank account. And inside that Swiss account, you hold investments in another Panamanian foundation. Each layer is in a different jurisdiction. Each layer has its own legal protections. Each layer has nominee directors or trustees, professionals whose job is to be the public face while you maintain control through carefully structured agreements that exist outside the public record. And crucially, each layer creates a break in the chain of transparency. Want to know who really owns that Swiss bank account? You'd need to pierce the BVI Corporation. To pierce the BVI Corporation, you'd need to get through the Nevis LLC. To get through the Nevis LLC, you'd need to challenge the Cook Islands Trust. And to challenge the Cook Islands Trust, you'd need to fly to a remote Pacific island, post a massive bond, hire local attorneys, and win a case that requires proving criminal intent beyond a reasonable doubt. It's designed to be impossible. And it is. The professionals who create these structures aren't criminals. They're elite attorneys, accountants, and wealth managers working for white shoe firms in New York, London, Hong Kong, and Zurich. They operate entirely within the law. Because here's the thing, offshore trusts aren't illegal. Using multiple jurisdictions isn't illegal. Having nominee directors isn't illegal. Each individual piece of the structure is perfectly legal. It's the combined effect that creates the problem. When you stack enough legal structures across enough jurisdictions, you create something that's technically compliant everywhere but functionally accountable nowhere. And this isn't some niche service for oligarchs and criminals. This is mainstream wealth management for anyone with serious money. The Panama Papers revealed that major banks like HSBC, Credit Suisse, UBS, and Deutsche Bank had aggressively marketed offshore services to their wealthy clients. These weren't back alley operations. These were the most prestigious financial institutions in the world, helping clients structure arrangements that would make their wealth effectively invisible to tax authorities. The Pandora Papers went even further, exposing exactly how these arrangements work in practice. Jordan's King Abdullah used offshore companies to secretly purchase 14 luxury homes worth over $106 million in the UK. The structure involved 36 shell companies created by English accountants in Switzerland working with lawyers in the British Virgin Islands. Each property was owned by a separate BVI company, and those companies were owned by other BVI companies that were controlled by Swiss wealth managers acting as nominee directors. Without the leak, no one would have known. The king's name appeared nowhere in public records. The properties were owned by anonymous companies. The companies were controlled by professional nominees. And the whole structure was perfectly legal under BVI and Swiss law. That's the pattern. Over and over. Russian oligarchs, African dictators, American billionaires, tech entrepreneurs, all using the exact same playbook. Anonymous companies in secrecy jurisdictions, controlled by nominees, holding assets everywhere from Manhattan real estate to London townhouses to art collections to cryptocurrency wallets. And here's what makes this truly impossible to audit. It's not just that the structures are complex. It's that the information doesn't exist in any single place. A U.S. investigator looking into suspicious wealth might find that the money flows through a Delaware LLC. Great, but that LLC is owned by a Panamanian foundation. The foundation is controlled by trustees in Jersey. The trustees were appointed by a Nevis trust. The Nevis trust was settled by a Belize corporation. And the Belize corporation's beneficial owner is listed as another trust in Liechtenstein. Each jurisdiction keeps its own records. Each jurisdiction has its own privacy laws. Some don't keep beneficial ownership information at all. Others keep it but don't share it with foreign governments. And even when there are information sharing agreements, the requests have to be specific. You can't just say, "Give us all your records." You have to know exactly what you're looking for, which is impossible when you don't know what exists. The IRS has been trying to tackle this for decades. In 2010, they passed the Foreign Account Tax Compliance Act (FATCA), which required foreign banks to report accounts held by U.S. citizens. It was supposed to be a game changer. But in 2024, a Senate hearing revealed that the IRS still couldn't quantify how much revenue FATCA had actually recovered. They'd assessed $14 million in penalties over 10 years. $14 million for a system that was hiding trillions. Why? Because FATCA requires banks to report individual accounts. But sophisticated wealth holders don't hold accounts in their own names. They hold them through offshore structures. And banks can't report beneficial ownership information they don't have. The money's in the system. It's just hidden behind layers of legal entities that the banks themselves can't see through. This is where the estimates get truly staggering. Gabriel Zucman, an economist at Barclays, has spent years trying to quantify offshore wealth. His research suggests that about $12 trillion in household wealth was held offshore at the end of 2022. That's just 12% of global GDP, and that's just financial assets, stocks, bonds, bank accounts. It doesn't include real estate, art, precious metals, or any physical assets. The Tax Justice Network estimates are even higher. They suggest that between $21 and $32 trillion are sitting in offshore tax havens. Their research indicates that this costs governments around the world approximately $427 billion in lost tax revenue every year. To be clear, that's not over a decade, that's annually. Every single year, nearly $500 billion that should be funding schools, hospitals, infrastructure, defense, just vanishes into offshore structures. In the United States alone, the estimate is that Americans hold somewhere between $1.5 and $2 trillion in offshore accounts. A 2024 Senate hearing revealed that the actual number might be double what previous research showed. IRS officials testified that based on FATCA reporting, they believed U.S. households were holding about $2 trillion offshore. And this causes a tax gap, the difference between taxes owed and taxes collected, of $441 billion per year in the U.S. But even those numbers are probably low, because they're based on what gets reported. And the truly sophisticated structures aren't getting reported. They're designed specifically to avoid reporting requirements. Here's an example of how this works. The Pandora Papers revealed a structure used by multiple billionaires where cryptocurrency played a key role. The individual creates a domestic trust in the U.S., which is reportable to the IRS. That domestic trust owns a Cook Islands Trust, which is also technically reportable. But the Cook Islands Trust owns a Nevis LLC, which isn't a trust and therefore has different reporting requirements. The Nevis LLC owns crypto wallets holding Bitcoin, Ethereum, and other digital assets. Now, here's the clever part. Cryptocurrency transactions don't go through traditional banks. They're peer-to-peer, or they go through decentralized exchanges that aren't subject to FATCA reporting. The crypto can be moved, sold, traded, all without any bank creating a paper trail. Then, when the person needs access to the funds, the Nevis LLC sells the crypto to a Panamanian foundation. The foundation converts it to cash in a Swiss bank account. The Swiss bank sends the money to a Malta-based company, which loans it to a U.S. corporation owned by the same person. At every step, the transaction is technically legal. The crypto trades aren't reported because they're not through banks. The Panamanian Foundation isn't subject to U.S. reporting. The Swiss bank reports that it has a Malta corporate client, which is true, it does. The Malta company is making a legal business loan. And the U.S. corporation is receiving a loan, not income, so there's no tax liability. The money moved from the U.S. person through 6 different entities, across 5 jurisdictions into cryptocurrency and back, and landed in their pocket as a tax-free loan. And every single step was legal. That's the system. And that's why nobody can audit it. But the implications go far beyond just taxes. This shadow banking system, this offshore empire, fundamentally distorts the global economy. It creates a 2-tier financial system where the ultra-wealthy operate under completely different rules than everyone else. Regular people pay taxes on their wages. The money gets reported to the government automatically by their employer. There's no opportunity to hide it. But someone with $50 million can structure their wealth through offshore trusts and potentially pay nothing, and it's not illegal. It's just sophisticated financial planning. This shows up in the data. Research by economists Annette Alstedsater, Niels Johannesson, and Gabriel Zuckman combined leaked data from the Panama Papers with tax records from Scandinavian countries. What they found was stunning. About half of all offshore wealth belonged to the top 0.01% of the wealth distribution. Not the top 1%, the top 100th of 1%. We're talking about roughly 10 million people globally owning about 1/3 of all offshore financial wealth. And for the truly elite, the numbers are even more concentrated. Their research suggested that the wealthiest 0.01% of households were evading about 25 to 30% of their tax obligations. Not avoiding, evading. The difference matters. Avoidance is legal, using deductions and structures that the law allows. Evasion is hiding income that should be taxed. But here's the problem. When the income is hidden in structures spread across 6 jurisdictions, all technically legal, what's the difference? The effect is the same. The government doesn't get the revenue. The ultra-wealthy don't pay their share. and everyone else makes up the difference. This matters because governments have to fund themselves somehow. If the wealthiest aren't paying, the burden shifts to the middle class and working people, which means higher effective tax rates on wages, more regressive taxes like sales taxes and fees, and less investment in public goods like education and infrastructure. It also matters for financial stability. Remember, this shadow banking system isn't just about offshore trusts. It includes money market funds, private equity, hedge funds, structured investment vehicles, all the non-bank financial entities that provide credit and liquidity to the economy. And these entities operate with much less regulation than traditional banks. They don't have deposit insurance. They don't have access to Federal Reserve emergency lending. They're not subject to the same capital requirements or stress tests, which means when things go wrong, they can go wrong fast. We saw this in 2008. The financial crisis didn't start in traditional banks. It started in the shadow banking system. Structured investment vehicles that held mortgage-backed securities couldn't roll over their short-term funding. Money market funds broke the buck, meaning they couldn't maintain their $1 share price. The repo market, where financial institutions borrow overnight using securities as collateral, froze up. And suddenly, the entire financial system was seasoned. The government response was massive. The Federal Reserve created emergency lending facilities for entities that weren't even banks. The Treasury guaranteed money market funds. We effectively extended the safety net to institutions that had spent decades arguing they didn't need regulation because they were in banks. And then, once the crisis passed, the system rebuilt itself. Shadow banking actually grew. According to the Financial Stability Board, global shadow banking assets fell slightly after 2008 from about 50 trillion to 47 trillion. But by 2011, they were back to 51 trillion. By 2016, they reached 100 trillion. And by 2022, they were at 148 trillion according to some estimates. The system that nearly collapsed the global economy doubled in size in a decade and a half. Because here's the fundamental problem. There's demand for the services shadow banking provides. Companies want credit outside traditional bank channels. Investors want higher returns than they can get from regulated banks. And wealthy individuals want the privacy and asset protection that offshore structures provide. As long as there's demand, there will be supply. And as long as different jurisdictions compete to attract financial services business, some will offer the secrecy and favorable laws that make the offshore system work. This creates a regulatory whack-a-mole problem. Close down loopholes in one place and the business moves somewhere else. In recent years, there have been serious attempts to address this. After the Panama Papers, there was a global push for beneficial ownership registries. The idea was simple. Every jurisdiction should maintain a registry showing who really owns every company, trust, and foundation registered there. And that information should be accessible, either to the public or at least to law enforcement. The European Union implemented this. The UK created its People with Significant Control Register in 2016. The United States passed the Corporate Transparency Act in 2021, which created beneficial ownership reporting requirements starting in 2024. These were significant reforms, and they've had some effect. The registries have helped expose some hidden ownership. The UK register has been used by journalists and researchers to uncover questionable arrangements. Law enforcement agencies have used the data in investigations. But they're also running into serious limitations. First, accuracy. The UK's Companies House, which maintains the beneficial ownership register, has been notorious for accepting inaccurate information. The system relies on self-reporting, and until recently, there was almost no verification. People listed obviously fake names, used addresses that don't exist, or claimed to be beneficial owners of dozens or hundreds of companies simultaneously. A 2024 review found that the data quality was so poor it was often unusable for serious investigations. Second, coverage. The registries only cover entities registered in their jurisdiction. If UK company is owned by a BVI company, the beneficial owner might be listed as the BVI entity, not the human being behind it. To find the real owner, you'd need to check the BVI register. But many offshore jurisdictions don't have publicly accessible registers. And even when they have registers, they often don't share them internationally. Third, enforcement. Even when ownership information exists and is accurate, using it requires legal authority. If a U.S. prosecutor wants information from a Cook Islands trust, they need to go through mutual legal assistance treaty processes. They need to make a formal request. The Cook Islands government needs to approve it. And even then, the trust might be structured in a way that the requested information doesn't actually exist in Cook Islands records. The U.S. Corporate Transparency Act ran into even bigger problems. In late 2024 and early 2025, federal courts blocked its enforcement, ruling that Congress might have exceeded its constitutional authority. Then in March 2025, the Treasury Department issued a new rule exempting all U.S. domestic entities from reporting requirements entirely. The registry that was supposed to shine light on American corporate ownership was effectively gutted before it even got started. Meanwhile, the offshore world keeps innovating. Cryptocurrency is the new frontier. Digital assets can be held in wallets that don't require a bank account. They can be transferred instantly across borders. Many exchanges operate in jurisdictions with minimal regulation. And the whole ecosystem is designed around pseudonymity, addresses, and keys instead of names and accounts. For offshore structures, crypto is perfect. A Cook Islands trust can hold a Bitcoin wallet. The wallet address is just a string of numbers and letters. It doesn't appear in any corporate registry. The trust deed might not even specify the wallet address, just authorize the trustee to hold digital assets. And if the crypto is moved to a different wallet or exchanged for a different cryptocurrency, there's no bank statement showing the transaction. We're potentially watching the creation of shadow banking 2.0. The old version ran through traditional banks and offshore jurisdictions. The new version might run through decentralized finance protocols and blockchain networks. And it could be even harder to track. So where does this leave us? We have a shadow banking system holding somewhere between $60 and $200 trillion in assets. We have an offshore trust industry that's structured specifically to be impossible to audit. We have beneficial ownership registries that are incomplete, inaccurate, and often unenforceable. And we have new technologies that could make the whole system even more opaque. The truth is, nobody can audit this empire because it was designed from the ground up not to be auditable. Every layer, every jurisdiction, every legal structure exists to create opacity. And as long as there are places willing to offer secrecy and favorable laws, as long as there are professionals willing to structure these arrangements, and as long as there are wealthy people who want to hide assets, the system will persist. This isn't about conspiracies or secret meetings. It's about incentives. Small jurisdictions can build entire economies around offshore financial services. Law firms can charge enormous fees for creating complex structures. Wealthy individuals can save millions or billions in taxes. And the global economy, as a whole, pays the price in lost tax revenue, increased inequality, and periodic financial crises when the shadow system stumbles. The Panama Papers and Pandora Papers showed us the scale of the problem. Millions of documents, hundreds of thousands of entities, billions of dollars. But they were just glimpses through small cracks in the wall. The vast majority of the offshore world remains hidden. And barring a complete reorganization of the global financial system, it's going to stay that way. Because ultimately, this is a coordination problem. Meaningful reform would require every major jurisdiction to adopt the same standards, eliminate secrecy, share information freely, and enforce the rules aggressively. But each individual jurisdiction has an incentive to defect. If you're the Cook Islands and you shut down your trust industry, the business just moves to Nevis. You've destroyed your economy and accomplished nothing. This creates a race to the bottom where no single jurisdiction can afford to be the first to implement serious transparency. The shadow banking empire isn't going anywhere. It's too big, too complex, too profitable, and too structurally embedded in the global financial system. We can map its contours through leaked documents. We can estimate its size through economic analysis. We can prosecute individual cases of obvious fraud. But actually audit the whole system? Actually see inside every structure, trace every dollar, identify every beneficial owner? That's never going to happen. Not with current technology, not with current political will, not with current international coordination. The empire remains in shadow because that's exactly where it's designed to be. If this changed your perspective on how the global financial system really works, hit subscribe. Because understanding these hidden structures, these parallel systems that shape our economy while remaining invisible, is crucial to making sense of everything from tax policy to wealth inequality to financial crises. The shadow banking empire doesn't get headlines like stock market crashes or political scandals, but in many ways, it's more important than either. And now you know it exists.